So I'm going to look at getting money out. That is, you have a pre-tax account. The two kind of pre-tax accounts you could have would be, you could have a 401k and you could also have an IRA. I suppose I should just mention as well the Roth IRA over here. So we're putting money in and we are happy because we don't have to pay taxes on the money we put in. In a 401k, we put money in and we're also happy because we don't have to pay taxes. Coming out, we're somewhat sad because we have to pay taxes, but there's no free lunch, right? So we have taxes after 59.5. However, if we're less than 59.5, we are double sad. Sorry, those are unhappy because we have to pay taxes plus a 10% penalty. Same thing is true for the IRA. Okay? If you're less than 59.5, then you have to pay not only taxes, which you were always going to have to pay, but you have to pay a 10% penalty as well. And so what we're going to look at is how can you remove that penalty? So let's say you establish yourself a nice hefty 401k, right? You're putting in $50,000, $55,000 a year through the mechanism I talked about with you put in your full contribution, your employer matches it, and then you put in a backdoor Roth 401k. But anyway, you've got a large 401k balance. What do you do? Well, the first thing you have to do, unfortunately, is you have to leave your employer. You can't take money out unless the 401k allows it, and very few of them do. You have to separate from service. When you leave a company, this is actually a key point. When you leave a company, what happens to your 401k? So you get three options. So you leave company. The 401k could stay if they allow it. They normally don't allow it because why do we want to let some old employee stay in our 401k? Okay, so this is usually no. They can cut you a check. Any guesses why you don't like this?
Because you might need to pay the tax for it?
That's right. Basically, that's going to be treated as you took all your money out. So you have to pay your taxes plus a 10% penalty on all this money. And then the third is you can roll it over. You can roll it over to a new 401k, like at your new employer, or an IRA. So let's assume for the moment you've left your employer. You have a chunk of money in your 401k. You're not 59.5, and you'd like some money out, and you don't want to pay a 10% penalty. All those things are true. So you would take your 401k money, you'd put it in an IRA. Roll it over, no tax consequences. Done every day. Now, you want to take money out, but you don't want to pay the penalty. There are a couple of ways you can do it. Most of the ways people normally look at are pretty useless. One, if you have a lot of medical expenses, you can withdraw and not pay the penalty. Okay, but you have to have a lot. So I think it's more than 10% of your income. First-time home buyer. Doesn't this sound handy? So if this is the first time you're buying a home, you can withdraw money from your IRA and not pay penalty on it. Does that sound useful? There is, however, a slight catch, and that is there is a limit on how much. Any guesses on what the maximum amount is you can take out to buy a house for your first time?
$10,000?
Okay, $10,000 is exactly right. That's the limit. So for a house, 10K max. That may be great some parts of the country, but here in California, that is not close to a down payment, right? So know that it's available, but it's not probably going to be very useful. So there are two main approaches to getting money out. And remember, you can always take it out as long as you're willing to pay the penalty. Okay? So that is always an option. There's no one that is preventing you from having that money. It's just the IRS is going to require you to not only pay taxes, but pay 10% penalty. So two approaches are: one, substantially equal periodic payments. This is also known as SEP, substantially equal periodic payments, or 72T, because this is the part of the tax code, just like 401k is part of the tax code. You know, the kth subsection of section 401 somewhere in the tax code. So substantially equal periodic payments says, let's say you've got, I don't know, $500,000 in your IRA. And let's say you are 35 years old. And let's say interest rates at this time are 5%. So this is the prevailing interest rate. You can use a couple different formulas. One formula is pretty easy. So you calculate every year, possibility one, every year, take balance over life expectancy, money out. So if you're 35 years old, what's your actuarial life expectancy?
I think around 80.
Oh, you're right. You're ready.
80 would be pretty, so, sorry, when I say life expectancy, remaining years. So 80 would mean that you would live to 115, which is probably overstating it.
Right, so then it would be 45.
45, so let's say 45 years life expectancy. So remaining life expectancy. How do you get this? There's a table, that the IRS publishes. So you would then take 500,000 divided by 45 your first year. So you would have just over $10,000, right? The first year. And then the next year, you would look at the new balance. Would it be more or less than 500,000?
Less.
Less. Why less?
Because you took out 10,000.
You did take out $10,000, but on the other hand, the prevailing interest rate's 5%, so you probably made 25K on it. So you're probably more like 515. So year one, you might be 500 divided by 45. Year two, let's say you put this all in a savings account at 5%, okay, or a CD or something like that. Then you really would have 525 minus 10, right? So there's about 10K. Now we'd have 525 divided by how much after year two? Is your life expectancy still 45?
44?
44, except it doesn't go down by a full year at a time, right? For example, if you are 79 and your life expectancy is 1 year, when you get to be 80, your life expectancy is not 0, right? So instead, it's probably every year it goes down slightly less than a year. And the older you get, the more of a year it goes down. So it might be, for instance, 44.1. Okay? So your total life was 80 here. Now you've made it to 36. You're like a total of 80.1. Okay? So this is, I don't know how big this is. This is 13K or something? I'm not sure what that number is. But in any case, you just keep doing like this. Until what happens? Until you get to be 59.5. Because once you're 59.5, you can take it out without 10% penalty. So this allows you to take 10K out without a penalty, 13K out without a penalty, whatever these numbers are. If your balance goes down, your amount goes down. Does this approach make sense?
Yeah, so this isn't like a workaround so much as something that's like actually allowed by your 401k.
This is in the IRS code allowed. The idea is, so the rationale is you put money in your IRA for retirement. And so they don't want you to take it out early. And so therefore they persuade you by applying this penalty, right? They had an incentive. However, if you are taking out in this substantially equal periodic payments, this is kind of like you retired early, right? You're still not projected to run out of money. You're just using this big pot of money for the remainder of your life. That's kind of like what might call a pension or something, right? And so you're just allowed to set this up earlier. By the time you're 59 and a half, they say, oh, you're old, and so therefore just take it out however you see fit. There's another formula. So this is one formula. There's a second formula, and that says amortize, balance, life expectancy, and interest rate. And this gives you a fixed amount per year. So one time you look and you say, I have $500,000. My life expectancy is 45 years. And at the 5% interest rate, and again, these interest rates are determined every month by the IRS, how much would this amortize such that I'd end up with zero at 5%? Right? So it's very similar to, like, if I borrowed $500,000 for 45 years at 5%, what would my monthly payment be? Except it's reverse. What sort of a monthly or annual amount of money would you get? This also works. The first approach has the advantage that it is going to increase your payments if you get more money, right? If you invest this well and this rises to $1 million, your yearly payments go up. And approach number two, it's fixed once you start. Okay? And if you do very poorly and your balance goes down too much, then all of a sudden, you might run out of money. Either of these cases, you have to go until you're 59 and a half. So the downside of this is you don't have a lot of flexibility, because once you start, you have to keep going until you're 59 and a half. Otherwise, bad things happen. You have to pay penalties on all of the money that you ever took out. So I'm going to show you a second approach of how to get money out. So there's two approaches. Substantially equal periodic payments is one, and these are subsections under substantially equal periodic payments. Questions on that?
Are these two approaches like either or? You can't do both?
Actually, you can, because when you do the substantially equal periodic payments, you're looking at a specific IRA or collection of IRAs, and you're allowed to have as many IRAs as you want. So what you could say is, I've got a collection of IRAs, or even I've got one IRA. I'm going to split it up into two. The part I'm going to do this on, and a separate part that's not affected. Okay? You would apply this to the first IRA or collection of IRAs, and then you'd have a separate IRA that's outside of that universe that you could still do whatever what you want. You could withdraw money and pay your 10% penalty. You could just let it grow. You could do a separate substantially equal periodic payments for that one. So you have some flexibility. But the key thing about this one, substantially equal periodic payments, is you have to take out every year exactly how much is in your formula. No more and no less. Otherwise, you break it and you have to pay penalties on the whole thing. Other questions?
Does this also work with like the Roth IRA?
The Roth IRA, yes and no. So yes, it will work if you're less than 59 and a half. The problem is, when you're taking out of your Roth IRA, you have to pay both taxes and a penalty. Sorry, you avoid the penalty if you do this substantially, but you still have to pay taxes if you're before 59 and a half. And now you're really screwed because you pay taxes on the way in and also on the way out. So our second approach is going to use a Roth IRA as part of our strategy. So we have to learn about Roth IRAs and how you can withdraw and at what ages and what gets taxed, because this second approach is very dependent on how Roth IRAs work. So I'm going to keep this collection of facts because that might be useful. We have our Roth IRA. Our Roth IRA has growth. You can withdraw from your Roth IRA with a happy face, right? You contribute with a sad face. You can withdraw contributions whenever you want with no penalties, no taxes, no penalty. If I were you, I would suggest it's important to have an emergency savings, right? I would make, at your age and at your income, I would store my savings in a Roth IRA. That is, if you made any money I would go ahead, you probably don't pay any taxes on it, put it in a Roth IRA, in a savings account or a CD or something like that. And that can allow you to put money in your Roth IRA. If you have an emergency and need to spend it, withdraw it. No taxes, no problem, just as if it was a savings account. But if you don't have to spend it and don't have an emergency, all of a sudden you've got money saved in your Roth IRA and you can never go back and make up past contributions you missed. If you finish a year and you don't make a contribution, it's over, you don't get to catch up. So Roth IRA is a great place for emergency savings until you get enough money that you have emergency savings outside of your Roth, and then you can start investing this. But keep in mind, Roth IRA doesn't mean investing in stocks. Roth IRA is just a type of account, and you can invest in many different places, including something very safe like a CD or just regular savings account. Contributions get withdrawn tax-free, penalty-free at any age. Also, conversions after 5 years. So I'll talk about conversions in a moment, but this is the key that we're going to be using. Your growth comes out, happy face again, after 59.5. But it comes out unhappy face before 59.5. So this is what you want to avoid. Does that make sense? These 4 parts. Conversion.
Like tax plus penalty, or is it just penalty?
Yeah. So this is taxes plus 10% penalty if non-SEP. So if you use the SEP, you avoid the penalty, but you still have to pay taxes no matter what. So let's say you've got this chunk of money in here in your IRA. You got $500,000, okay? You're 35 years old, and you would like to be spending some of that money. But you have an aversion to paying a 10% penalty. Here's what you could do. And let's say you can afford to wait a few years before you take the money out. In fact, let's say you want to withdraw money when you're 35 years old, but you're looking ahead. And so at 30 years old, you say, I need to prepare for when I'm 35. And so at 30, you convert, I don't know how much, 25,000 from your IRA to the Roth IRA. Okay? So you had this IRA over here. You have a Roth IRA over here. I don't know how much money it has in it. Maybe you never made any Roth IRA contributions. Maybe it just has $1,000 in it. Okay? You take $25,000 from your IRA and you put it in your Roth IRA. What taxes are there on that transaction?
Is it just the tax on the contributions you made to the IRA?
It is. So when you withdraw money from your IRA, you have to pay taxes. So you're going to have to pay taxes, but no penalty on the 25K. All right? You with me? And now you're 31 and you do the same thing. And at 32, the same. And at 33, the same. And at 34, the same. Okay? And you said to yourself, well, that was fun. I got to pay taxes on $25,000 worth of income for 5 years. Okay? But remember, there's no way to ever withdraw money from an IRA without paying taxes. So we had to do this no matter what. The only problem is we don't have our hands on the $25,000, and that's what we want to do. But here's what we're going to do at 35. At 35, this amount here, how many years ago did we put that in? Now that we're 35. It was 5 years ago. Conversions after 5 years can be withdrawn tax-free. So now we can take out 25,000 from the Roth, no tax, no penalty. Okay? And we could do the same thing at 36, 37, 38, 39. So we take it out and pay taxes, we put it in the Roth, and then we just start the clock ticking for 5 years. We do it the next year. Take out 25 or however much we think we're going to want to spend in 5 years from now. pay the taxes, put it in. And then when we get to 35, we take it out and don't pay taxes. What if we're going to want to be taking out money at age 40? What else do we need to do this year that we're turned 35?
Put some money in.
We need to, again, convert some money. So convert 25K more. Okay, so notice when we get into the steady state, we're taking money out of the Roth and not paying income tax, but we are converting from our regular to our Roth and paying income tax, but we're avoiding any penalty. This is called a Roth ladder. Roth IRA ladder. It does require some planning because you need to start the clock ticking for 5 years before you can actually take anything out. So you need to have some money that you can live on. You need to also be paying taxes sort of 5 years ahead of when you're actually going to get the money. But once you've got it going, it works pretty well. And it's flexible because you can stop it at any time. You can change these numbers from year to year. If you put 25,000 in here, you can take out less than 25,000 here. You can't take out more, of course, but you can take out up to the amount that has been in there for at least 5 years. You could do this conversion for 5 years and then not take anything out till 10 years from now. And you'd still have that whole amount you converted that you can take out before you're 59 and a half with no additional taxes or penalties. Okay. So what I'm trying to address here, right, the reason for this is people sometimes think, I don't want to put all this much money in 401ks or IRAs because it's useless to me until I'm 59 and a half. And what I'm trying to show you is it's not. You still can get access to it, even with and without even paying 10% penalties if you arrange your affairs correctly. Questions?
Is there any amount of time that you have to wait before you convert from an IRA to a Roth IRA? Can you just put it in an IRA and then immediately convert it to a Roth IRA?
Well, that is exactly what the backdoor Roth IRA is. So the backdoor Roth says, I am not eligible to contribute to a Roth IRA because my income is too high. I can contribute to a regular old IRA with no tax deduction, and then I can immediately convert it. So it's just as if you'd made a contribution to the Roth IRA. So there's no reason you shouldn't be making $6,000 contributions, assuming you have some income, while you can. And if you have, $3,000 in a bank account, then my claim is you should still make a Roth IRA contribution of $3,000, put it in your Roth, and you can always withdraw it if you need to. Okay? But you get this optionality, which is maybe you'll get to save it in your Roth, and then this growth, this wonderful growth happens. How does this sound as a strategy? Do all of your savings in Roth vehicles. Roth IRAs, there are actually Roth 401ks too, so that you never have to pay tax when you're withdrawing money. Does that sound like a good strategy or a bad strategy?
What about emergencies? So
in emergencies, you can always withdraw your Roth contributions. So I guess what I want to say is compare doing a Roth to a regular. So do I want to put it in with a Roth where I don't get a deduction up front, but I get to take it all out tax-free? Or would I rather do a 401k, or would I rather do a combination?
Probably always do Roth.
Okay, so let's say you do Roth, and then you get to be, 50, and you have a nice Roth balance, and you withdraw some money from your Roth. How much income tax are you paying, assuming you don't have a job at that point? So your only income is your $100,000 you took out of your Roth. How much tax will you pay?
Zero?
Zero. You don't want to pay zero tax. The reason you don't want to pay zero tax is because taxes don't start at zero, right? If you make $1 in a year, you don't have to pay any taxes. If you make $100, you don't have to pay taxes. What about if you make $10,000? Do you have to pay taxes? And here we're talking income taxes. So there is what's called a standard deduction of $12,000. So unless you make more than $12,000, you pay no taxes. So you don't want to waste that, okay? And even above that, the tax rate is fairly small until you get up a fair amount. So if you were working and paying 25%, had a 25% tax bracket, so paying 25%, and then when you retire and you're in a lower tax bracket, it might make sense to have some money here, taxable, that you can ostensibly pay tax on. Okay? You could, for instance, convert some of your IRA to a Roth IRA. Let's say you're withdrawing from your Roth IRA enough to live on. You can still use up your 0% tax bracket converting your IRA. So you kind of wasted some of your tax, wasted some of your 0% tax or low tax when you could use it in later life. Does that concept make sense or not? I guess what I'm saying is, at 50, pay 0 taxes, no income, withdraw from IRA, let's say 100,000 from your Roth. An alternate approach would be withdraw 88 from Roth and 12 from traditional. Still 0 taxes, but notice how if you had saved some of your money in a traditional IRA when you were working, you save taxes at that point. So that's a case in which you paid no taxes going in and you pay no taxes going out, because at the time you're going out, you have a low enough taxable income that you're paying nothing. So having a combination of IRA and Roth IRAs probably makes the most sense.
Can this happen at 50 or does it need to be after 59 and a half?
So that's a good point. Maybe what you're going to do is, so let's change this to withdraw 100 and convert 12. Okay? So you're converting this into the Roth that you can now take out 5 years from now. And so when you put the money into the IRA, the regular traditional, you pay no taxes. And when you convert it, you pay no taxes, because your taxable income is just $12,000, because your 100 from the Roth doesn't count. That was a good point. Okay, I think that is it. Any last questions?